What is going on, everybody? Rasul CRE back at you with another video. Today, I'm going to be talking about my latest acquisition, Disrupt Equity, partnered with Open Door Capital. And this is going to be the Hill at Woodway, 248 units in the beautiful, growing, and booming town of San Antonio, Texas. And I'm going to be going over a lot of different factors, especially as some of the frequently asked questions that I've been getting about multifamily investment opportunities with the shift in the market. How are we able to find deals that work, and how do we make them work when they are still at high prices, high interest rates, high insurances? I'm going to be talking about all of these things. And if you guys have questions, feel free to write them in the chat. I'm going to pull this up right now. Because at the end of this presentation, I will be doing like a Q&A, and I'll go over everything that you guys want to know, what you need to know in order to fully understand this investment opportunity. So real quick, I got a few of you guys in here, some people I haven't met before. Lynn, I saw that you were referred by Lavi, I believe. Oh, she's muted. All right. Well, I mean, for you guys, by the way, I like to do my presentations with a lot of interactivity. So if you guys want to, chat back, let me know. I am completely down for all of that. First of all, can you guys hear me?
Yeah.
Okay. Excellent. Okay. Yeah, that'd be the worst thing if I go through this whole entire 45-minute presentation and nobody can actually hear me. But I'm glad my audio is working really well. Good to have you guys on here. And it's about 10:03. I usually give people a couple more minutes to trickle in, but I don't want to punish you guys who are on time and early. So I'm going to go ahead and go through all of this and make sure that you guys get all the information. The other guys, they can watch the beginning on the replay. And without further ado, I'm going to go ahead and present this to you guys. So first off, my name is Rasul Mutawakil. I am the Director of Acquisitions for Disrupt Equity. Been with them since 2021, and we've done tons of deals. Disrupt Equity manages currently over 7,000 units of multifamily, majority in Texas. We got some in Florida. We've got some in Georgia as well. In my portfolio, inclusive of we have Disrupt, I've got 3,311 units myself. I'm getting ready to close on a 673 unit portfolio probably next week is what the lender is saying right now. That one is 2 properties in Houston, 1 property in Austin, Texas. Fantastic deal. Kind of similarly structured in how this San Antonio deal is working, which I'm going to explain to you guys about how multifamily investing is working. And so if you guys do have questions, my chat's pulled up, so I'm ready for that anytime. So yeah, I've been multifamily investing since 2020. I came from the residential side. I was running Airbnbs and long-term rentals here in South Florida. And, once I learned about, the scalability and the speed and the ease of which you can grow in multifamily apartment buildings, it just made sense for me to make that transition. So I've come over as an active investor, also a passive investor. I invest into basically every deal that I do whenever I have the capacity, because these are longer term passive income plays to set up generational long-term wealth and cash flow, and that's really what this is all about. So if you guys have questions about any of these types of things, my forte, my skill set is in property analytics, market research, as well as being very, very good with math. My W-2 that I had before I went full-time into real estate was as a senior financial analyst for the Department of Housing and Urban Development. So you can imagine some of the tiptoe gray areas that I had to walk around in doing apartment building investing and being a federal employee on the housing side. So this property here is called the Hill at Woodway Apartments. It was built in 1986. It's 248 units, B+ property. You guys will see the market as I go over it. We got this one it's pretty awesome how this deal came along, because most times when you're doing a deal, you're looking at stuff that's already listed on the market. A broker just puts stuff out there and has everybody is like a free fall pretty much. But in this particular case, what we were able to do is be on the short list of buyers from the broker, and we got first crack at this deal before anybody else got to see it publicly. And so it was kind of like, I don't know, I wouldn't call it really like a silent auction, but it was like a private endeavor in which only qualified buyers who have a track history of being able to make these deals happen were able to go ahead and take a look at this. And we saw it. The price that they had it was okay, but we negotiated it down a little bit further to, increase our spread on the deal, and we ended up winning it. And that's how we found this deal. So as a general disclaimer, you guys can pause on the replay or watch it over and just understand that I'm just giving an overview about this, but you should definitely make all your consultations, do your due diligence and all that good stuff. Same thing with the financial disclaimer. There are no guarantees in any type of investments whatsoever. I do like the low risk, high reward nature of multifamily, but again, always do your due diligence, and that's what these disclaimers are for, right? So the overview of the team, my squad, Disrupt Equity Partners. I even got the t-shirt literally to show my support. Disrupt Equity, the owners, Ferris Musa, Ben Suttles. I work very closely with Ben every single week. We analyze everything that's in our pipelines, and we're the ones who are driving the acquisition part of finding these deals for the whole agency, right? And Ferris is more on the management side, CEO of Disrupt Equity, running everything from up on high. And our other private equity firm that partners with us, Brandon Turner, Brian Murray, they're the founders and CEOs. He's the founder and CEO of Open Door Capital. He's a co-founder, as well as Ryan Murdoch, the other co-founder, and they do some phenomenal work. So they raise a ton of equity into these deals, similar to what I'm doing right now, but obviously their reach is way higher. So that's why when I have the opportunity to come in, these guys are vetting the deal from a very high level, and they've got an entire company dedicated to scrutinizing the underwriting on these deals to make sure that it's a worthwhile endeavor for them, because they've got like tens of thousands of units under management and purchase over a very long time. So the partnership that we have with them has been phenomenal. They've done, I want to say, maybe 8 or 9 deals with us, and we're just continuing to grow the relationship. It's very synergistic with what they want to do and what we are doing as super strong operators. So they put a lot of faith in what it is that we do. So this is the executive summary of the deal. I'm not going to read to you everything about this, but some of the highlights. We're targeting about 6 to 8% average cash on cash, which is right where we want to be for being able to hit those distributions on a monthly basis. And then also we're talking about a 16 to 18% all-inclusive average annual return by the end of this project. So we're going to be doing a value add that's already proven in place, and I'll show you guys the numbers and how that works. And there's a lot of upside for what we're going to be able to get from doing the renovations to the existing property and just make it a little bit nicer. We have some ideas for some really cool amenities that we're going to be adding as well, that we already have at other properties that are in this submarket. And so it's already a proven concept. We're just basically rinsing and repeating the process to replicate that success. Another investment highlight. So this deal actually has 2 classes of investments. There's a class A, which is already fully subscribed. I'm sorry, it fills up so fast. Like as soon as the first email goes out, it fills up, because that's a smaller portion, probably have a couple million in there, and it's first come, first serve, and these guys are already filled up for that one. But the good side of the class A is that you're going to get 10% on your money. The bad side of the class A is that you do not get to participate in any returns that are above and beyond that. And so the class B shareholders get an 8% return on their money. And because they're taking, I guess you can call it increased risk, where they're not getting the guarantee, not the G word, not saying guarantee, where they're not getting the 10% preferred return, right? They're getting the 8% of the class B, but they also participate on a 70-30 split, 70% of the upside that we have on the back end after we do our improvements, our increased valuation of this property. San Antonio is one of the hottest growing cities in the entire country. It's the 9th largest city in the United States. A lot of people don't realize how big and how quickly San Antonio is growing. If you think about, like, I guess if you would say arguably the hottest market is Dallas and Dallas-Fort Worth, how those twin cities have grown together. Austin and San Antonio are basically doing the same thing, because a lot of population influx into Austin itself is quickly raising the prices from people like from California moving into Austin. I guess that's the city that they all really, really like. And my guess is that Austin tends to be a little bit more liberal out there, which is in line with what they do in California. And all of that driving into Austin is forcing prices up and people out. And the closest city for people to go to is San Antonio. It's the next major metro that they can get to. And so that is forcing them to grow. And they're going to basically, they're projected to be like the next Dallas-Fort Worth combo. And that's why San Antonio is growing so fast. And that's why we love this opportunity so much, because we're able to get in front of all of that action that's going to be happening over the next few years. And so got a lot of value add opportunity there as well. And I would say in today's market, with the crazy high interest rates, right? That's what's really killing a lot of these deals. That's what's making it very difficult for people to be able to make deals pencil well, is because if you're buying a property at a 6% cap rate, but you're borrowing money at a 7, 8, or 9% interest rate, you're just upside down fundamentally. Right? You'd have to put like a crazy big down payment, in which case you bring that much capital to a deal, you don't have the benefit of leverage, and your return metrics are a lot lower. So the way that we circumvented that in this deal, and same thing with the Texas 3-pack, is that there's already an in-place loan that has 4.2% interest, and it's on a fixed rate. And on top of that, instead of it being amortized over a 30-year period, it's actually a 35-year amortization. So our monthly payments are even lower. And so by being able to assume this loan that's already in place, and we're working with Freddie Mac directly to be able to assume this loan, they do their due diligence on us as operators, and they make sure that it's okay for us. Because if it wasn't okay for us, if we didn't have the track record that we had, they would not allow it, and it would force the seller to either sell to somebody who did have the track record, or they would just force the seller to sell it altogether and have the new buyer get new in-place debt at today's higher interest rate, right? So that's what is making this deal work out really, really well for us. And the other beautiful thing about it is that at the purchase price that we negotiated down to, this loan that's already in place, where these guys have had this property for like 4 or 5 years already, we're only at a 64% loan to value. So we're very low levered into this deal. Right. So that just puts us at a lot less risk in doing this. Apartment fundamentals, 7% growth. Again, the targeted average annual return is super high. We love these types of things, right? So without, here is the property overview. As you can tell from the pictures, this property is actually well kept. We were surprised at how nice and how manicured this property was. They took really good care of it. It doesn't even look like it was a property that was built in 1986. So they put millions of dollars in capital expenditures over the years into this deal in order to make it what it is. So this is basically the premise of the deal: 248 units, there's 22 total buildings. It's super stabilized at 95% present occupancy. Whenever you look at a multifamily deal, one thing that you can tell is how strong a deal you have based on the occupancy. Because if you have a deal that you're looking to buy and the occupancy is like in the 80s, then there's some red flags there that should be going off. And it's like, wait, well, what's wrong with this thing? Why is it that they cannot retain tenantship, right? And so being able to get into this deal with 95% occupancy makes it a lot easier for us as buyers to be able to execute the business plan, because those 5% vacant units are the ones we're going to start doing our renovations on. And they've already proven that once you renovate, you're able to get higher rents. And we see it on the rent rolls and the financial analysis that we've already done. And so right now, the in-place rents are only $1,122. And as you guys will see with the market, there's way more runway than we're actually projecting to be able to get, right? Another nice picture of the leasing office here. A couple of different floor plans that they have. It's all 1s and 2s. Some of the unit features. Now, the platinum renovated units, these are the high level renovations. You can see here, I'm not going to read the whole entire material list here, but they're nice quality things that they have in there. And this is in line with what our business plan is for what we put in. All of our units, if you guys have ever done any property tours with us on our deals in Texas, and by the way, if you want to be able to do that, let us know. We can always schedule something out there. And it has to be kind of like an organized thing. Or if you just want to show up, you can like kind of secret shop and just pretend that you're looking for a place to rent. I mean, it is an apartment. It's open to the public anyway, right? So you can always show up. And if you see what our renovations look like, we like to keep it very nice and modern, because the whole philosophy of doing multifamily investment with disrupt equity, our goal is to create strong family communities where people want to stay for the long term, plant roots. And that's why we are so big into the amenities, the playgrounds, the things for people to do, just not just make it a place where you have a roof over your head, but actually turning it into a home and a community where you would love to be able to live. So right now there are 63 classic units, meaning that they have not been renovated that much. They have a lot of the original, like 1986 white appliances, laminate countertops, original cabinetry, like these things, like you can see night and day between what the platinum upgraded, fully upgraded properties look like, units look like, and then this is what the classic looks like. So it's a stark difference, and that's why we're going to be able to get the much higher premium once we do these renovations. And then the partial renovation renovated units have some of the upgrades, and you can tell it's a little bit nice. It's a lot nicer than the classics, but not as nice as the platinum here. And so our goal is to be able to get all of these up to snuff, and we'll go over the math on how that works later on. So one of the things that we look for whenever we're doing our value add, our consideration of our capital expenditures, the money that we bring to the table to make sure that we can do our renovations, is we have to make sure that we're hitting a certain return metric, and we're targeting 25%. So if we're going to spend, $4,000 on a unit, we want to be able to earn back $1,000 over the course of that year. And that gives us kind of like a mathematical proven way for us to be able to do our value add plan. All of these things really come down to the math of it, right? Because as long as we can deploy the capital and get our return, that's what keeps us safe in knowing factually, right, with a proven history and track record of things that have already been done. We're not just guessing about what's going to be happening in the future. We've already done these, right? So this is an aerial view of the property. You can see all of the units, and it's like everything's just in really, really good shape. They took really good care of this property. So you can do a virtual tour. I'm going to send you guys a copy of this, by the way, so that you'll have this for yourself. You can look at everything, follow the slides. You can click the virtual tour of the property, which is pretty cool. You can do there. And this is more pictures. Some of the amenities that we have: super nice leasing center. The fitness center is really good shape. Gated dog parks, picnic areas with the grill, picnic tables. A lot of the courtyards, like I said, communities that we really like to have people have the ability to just be, feel like it's a home, a place that they want to have pride of ownership. Pride of ownership is one of the tenets that we live by on our management side, to make sure that people are, super happy with where they're at, because our business plan is furthered by people renewing and staying for a long period of time. We don't want people coming in, oh, this place sucks, and then they leave after their first year in the lease, right? So more pictures. San Antonio itself, if you guys are not familiar, I've been there a couple times. This is where the property is located right here. One of the largest employers in the country, actually. USAA is a huge insurance firm. I actually used them from when I was in the military, and they employ over 10,000 people at this one location. And so that's going to be like our target. And then also UTSA, University of Texas, San Antonio, is also over here, and they're like less than 5 miles away. Obviously, I got my Costco. You guys have heard how I like to make sure that I have a Costco. I also like Whole Foods. These different types of companies that do market research about where they want to plant their roots, where they want to grow, right? They do their market research. And if you think about the type of people that shop at Costco, that shop at Whole Foods, they are of a particular tenant demographic, and that's in line with what we want in a B+, A- type community. And also, obviously, the medical center is right over here. Lots and lots of opportunity for us to be able to just fit right in, and we're nestled firmly in between everything over there, right? So a lot of strong fundamentals. I'll read the highlights over here. It's fastest growing city in America. It's like top three richest cities in Texas, Alamo Heights. And then number 4, the hottest housing markets, Zillow 2022, so very recent. And we have a lot of expected urban growth rate. I talked about that in the beginning, about how San Antonio and Austin are like growing like twin cities the same way Dallas and Fort Worth had been doing as well. And best housing market for growth and stability based on smart assets assessment back in 2023, way back, right? A long time ago. And we're number 9 for that one as well. So it's a super strong market. It's got a lot of awesome fundamentals that we like and that we look for a long-term hold, right? Because these multifamily deals, it's not a quick, get in, get out and, make your money. This is a long-term project. And the longer that we're able to participate in the rapid growth of San Antonio as a city, the more upside that we're going to be able to get along the way. So these excellent demographics, huge population in the MSA. We're looking for even further growth, more influx of people coming in. You can tell like almost 250,000 people coming into San Antonio specifically. The demand is probably not going to be able to keep up with that, which is also going to further raise property prices, rent prices, and all these other things. These are the things that we're looking forward to. And we're not banking on these things happening, by the way, because our projections for rent growth and all those other things are very conservative. We are expecting for these things to happen. We would like for these things to happen, but they do not have to happen in order for us to hit our return metrics that we're projecting over here. Median sale price of homes, really high rentership base for this MSA, and then tons and tons more jobs that are coming in. More drivers about why we like this type of property. So the South Texas Medical Center, really close by, that whole entire campus is like 900 plus acres, got over 60,000 jobs, wages and salaries in the 3.1 billion, and then annual revenues about 98.1 million. Just absolutely super strong economic indicators. And if you guys have questions, by the way, again, feel free. And as a matter of fact, let me put this in the chat since you guys are here. All right, this is the link that I just shared is the investor link form for you to be able to put your information if you want further information or schedule a call with me or anybody on my team to talk about investing into the opportunity. We'll go over all of that in a little bit as well. So this is more of the highlights. We're less than a mile away from USAA's corporate headquarters. They're a huge campus as well, almost 20,000 employees. And a lot of the other just close things that we like about Hill at Woodway and where it is. We're like 2 to 5 miles away from luxury retail centers. We're 3 miles away from the University of Texas, San Antonio. We're 10 miles away from downtown San Antonio. So we're not crazy in the mix. We're far enough away where people can have that, that peace of mind and that community, that home style life that we're talking about. And there's a lot of things that are going on as far as development from the city itself, right? I mean, Microsoft is building this $250,000 data center. The airport is going to be $2.5 billion of expansion out there because they're anticipating all of this rapid growth, and they're going to be able to need the infrastructure to be able to deal with that. So if the city is already seeing that and they have plans to go there, it just further reinforces our thesis that San Antonio is a great market to be in. And we've already experienced that with the deals that we have out there that have been doing really well for us as well. So here is a comparison of the 1 bedrooms and the 2 bedrooms. And you can see that the average rents are at $1,176 right now from everything in place. On the high end, premium wise, when we do our luxury upgrades, we're looking at even more upside, but we're not trying to calculate at that right now. I believe we're targeting only 1,100. Okay, well, I guess. Yeah, on our 1 bedrooms, we are not, we have the ability to capture that market, upgrade that market premium from doing our fully renovated units at the platinum level. However, even with those renovations, we're only estimating about half of that growth, and we're still being able to hit that 16 to 18% average annual return metric. And on the 2 bedrooms, same thing. Market premium super huge. The average is 14.24. And for our effective rate right now, we can see we've got a lot of runway to go there, right? So the details of the investment itself. So this is a 506C, which means like if you guys are new to multifamily investments, there's basically two types of syndications. There's a 506B and a 506C. And this is a 506C. And the main difference is that 506C is open only to accredited investors. And accredited investors are anybody that has a net worth of $1 million or more, not including their primary residence as a married couple or individual, or they have, if they aren't single, they have made $200,000 per year for the last 2 years with a reasonable expectation that they'll continue to make $200,000 this year. If you're married, change that 200 to 300,000. And those are the two main ways to qualify as an accredited investor. There's other various licenses that you can hold, be able to do that as well. But odds are if you have those licenses, then you know that you're an accredited investor. And a 506B is for unlimited number of accredited investors, but up to 35 non-accredited investors. So if you don't meet those financial criteria, they do allow for up to 35 people to invest in these. They have to be a sophisticated investor, meaning that you just understand what you're investing into. Now, the major difference, and the reason why that we're doing a 506C versus a 506B is not because we don't want, it's not that we only want to be able to cater to rich people. The biggest difference is on a 506C investment, we are free to advertise. I do a lot of stuff on social media. Brandon Turner obviously has a really big social media platform, and he would be hamstringed if he didn't have the ability to advertise. And so same thing with me. The reason why you guys saw this event is because I created something publicly on Facebook, on Instagram. I have ads that are running out there and it's bringing you guys in. You can only do that on a 506C. On a 506B, you have to have an already pre-existing relationship. So you guys who are watching and people who are watching the replay, if you have never seen me before, you never met with me, even if this was a 506B, you wouldn't be able to participate because the offering exists before our relationship was established, right? So those are the two main things to understand about this investment type. This is a Class B multifamily apartment. I call it B+, somewhat of an A- way that it looks there. You might be hesitant to do that because it's built in 1986, but I think it's in really, really good shape. So the investment strategy, we're planning on holding this for at least 5 to 10 years. 10 years longest term for what we projected out, just given the current state of the economy, right? Because we're on some shaky ground. A lot of people are always talking about, oh, recession, pullback in the market, everything like that. We have the ability because there's 7 years left on this loan, and then we can refinance later on down the line for a further another 3 or 5 years if we really need to, if the market demands that, because things are just falling apart. So having that runway is what is going to give us the ability to escape that whole recession thing, because we have fixed interest on our property. Rents are very stabilized even through the recession historically. And so we're able to weather that storm and get to the point where the economy is back in recovery and back on the upswing, and then we can sell at the right time. We just had the option to do so. Historically, we've only held properties for about 2 to 3 years before we're able to hit our return metrics and then sell out and then just be super profitable on the back end. So the projected hold period, 5 to 10 years. Minimum investment is $100,000. If you guys wanted to come in less than that, you'd have to contact me directly. I have to see what we have, because sometimes towards the end we're able to fill up just some of the missing, because it's not a fixed $100,000 increment that we're on. So we might be able to get somebody in a little bit less than that. The Class A structure gets you a 10% preferred return, no upside on a liquidity event, sale or refinance, but we have the strong cash flow up front and reduced risk relative to Class B. Now, Class B, you're getting your 8% preferred return, and that is and that's why the Class A gets paid out first at their 10%. And then after they're paid their 10%, then the Class B shares go to their 8%. And then after the Class B gets their 8%, then it goes to a 70% to the Class B, 30% to the general partners. So we're all the way at the bottom of the pecking order there. And the Class B is right in the middle, Class A is right at the top, right? That's why it gets filled out so fast. So some people they don't care about the upside. They just want the predictable 10% average annual return on their deal. So, but by being Class B, you're able to almost double what they are. And by the way, historically, average-wise for disruptive equity across our portfolio, we're averaging 50.6%. Now, that is not to say that that's going to happen on every single deal. That's a combination of some, right time, right place. Like when COVID happened, valuations on some of the properties went through the roof, and we sold as quickly as we could, because if people were buying that and we got like triple digit returns, we capitalized on that, right? Distribution timing, we're looking at monthly distributions, and they're estimated to begin about 6 months after closing. So just so people understand the mechanics of what happens when you do a multifamily deal. As you're transitioning from the old seller to the new owner, there are tons of cash going back and forth, different accounts and all this other stuff. So immediately upon closing, we set that date in stone, take a picture of what everything looks like. And then over the next few months, we reconcile all the accounts. And once we do that, then we're able to start our renovation process. And we want to make sure that everything is going. So we have a whole entire process. We do this every single time. That's why at 6 months after closing, that's when we get our distributions. Matter of fact, from our Derby deal that we closed earlier this year, distributions are starting like clockwork, right on time. And then the tax advantages, we should be able to close this in 2023. So we would be able to get that estimated 45% bonus depreciation to be effective for 2023, which is huge because in this year, they're starting to sunset the bonus depreciation. This year is only 80% of the available amount. And so last year was the last year for 100%, 80% this year, 60% next year, 40% the year. So it behooves you to get involved, especially for the tax savings, earlier into a deal, because otherwise you're going to be missing out on that 20% bonus depreciation, and you end up paying more taxes as a result. So investment projections. So this is from our Class B capital balance. You're looking year 1 to year 7. Cash on cash, you see, is a little bit low in the beginning, obviously because we haven't executed any of the business plan to increase the rents. We haven't added the amenities. We're adding, I think, 140 washer and dryer hookups, which is going to be huge, because whenever I don't know if you guys have ever rented before, or lived in an apartment building, and you didn't have washer dryer hookups, and you had to walk either to a laundromat, or you had to go and try to compete with somebody at the laundry facility on site. It's a big nuisance, and you end up wasting a lot more time and all sorts of stuff. And so by having the convenience of having a washer and dryer hookup in your unit, people easily pay their $50 for doing that and having that ability. So once we do all those types of things, you can tell over time our cash on cash is getting better, right? So on $1 million balance, distributions from the operations are as such. And then ultimately, once we go ahead and do our sale on the property, return your capital, and you're getting your $785,000. And that is what's going to hit these return metrics. That's why we're projecting 17.74, equity multiple of 2.24. So an easy way to digest all of this is whatever you invest, multiply by 2.24. That's what you should be getting back, inclusive of your initial investment, right? So that's what that is. So you put in $1 million, you're going to profit 1.2 million bucks on the back end. And this is a sensitivity analysis. So again, a lot of what we do is educated guesses and projections based on the history of what has happened, and also what we believe is going to happen in the market given different market conditions. And so increased interest rates, right? Exit cap rates going up as a result. And so if the market goes worse than what we think, now we're looking over here around a 14% average annual return. If it goes better than what we think, and the cap rates start to compress again, and interest rates come back down to the way that they had been historically, we're looking to be somewhere around 22.5%. And that's using our conservative metrics of not capturing full premium rent growth and all of these different types of things. So you can take a screenshot. Again, I'll give you this whole entire presentation pitch deck so that you can have all this stuff and really study it and learn it more. But baseline, we're looking right here, stabilized economic vacancy at 10%, meaning that between vacancies, loss to lease, bad debt, all the other stuff, we're losing about 10% of what we should be collecting. We're still going to be averaging 17.7% average annual return. Our cash on cash is going to be 6.5%. And this is what we're projecting for rent growth. Even though some of the markets had, gone a lot higher, right? Historically, I mean, in the last couple of years alone, we've seen like 25-30% growth rates in certain markets. We're only estimating 3%. And that's par for the course for us. And that's part of the reason why it takes us so long to find a great deal, for one, because we're really severely underestimating what inflation is going to be on the rents. And two, it actually explains why our average annual return, like our actual returns, are so much higher on the back end, because we kind of underpromise, overdeliver. That's another tenet of what we do as investors. Average annual return 17.7%, 6.5% cash on cash, and then the exit cap rate at 5%, which is par for the course for this area. Okay, so two-tier structured return, we talked about that before. We have the Class A and the Class B limited partners. The Class A has the 10%, Class B has the 8% preferred return, but they also get 70% of the upside, 30% goes to the general partners. And so this is what the entire capital stack looks like. We're assuming the $21.3 million in debt that is locked in at fixed rate, 4.2% interest, right? And we have 7 years at that loan rate. So we're going to be safe all the way until like 2030. And then we also have some interest only periods. So it's not even going to begin to amortize. And then once it does amortize, instead of a 30-year timeline, we're on a 35-year. So our monthly payments are even lower. So I mean, just crazy, fantastic opportunity to find something like this. So our plan with the capital improvements, where we're going to be putting our CapEx budget, $560,000 going to the exteriors. A lot of the amenities going to have $354,000. And some of those things are including like tech packages for this deal, because again, it's built in 1986. It's not as modern as a lot of the other things. And so some of the things that people expect, especially in this market with sophisticated tenant base, you're looking at, Nest thermometers. You want a lot of wireless capabilities. You want keyless entry into your units. And these are another, set of value add that we're being able to provide to the property. Interiors, $935,000. A lot of that is going to go into building out those washer and dryers for the washer and dryers for each of the units, to make sure that they all have the ability to do their laundry in their own unit. And then we have a $100,000 contingency, because if you've ever done any type of real estate work, you set a budget for what you want to spend, and then when reality hits, there's always something extra that comes up. You get behind a wall and you see that something is not quite the way that it looks. And even during the inspection, you can't really find these things until you open up and see what's really back there. So we have a contingency to make sure that that goes over there. And then we have our construction management fee of, not a fee, but it's a set aside that we have just to be able to have these guys make sure that everything goes really well. And so all in all, $1.9 million, about $8,000 per unit, which is very par for the course for capital expenditures. And these are transparent fee structures, how everything is, the fund sources, the fund uses. So the preferred return for Class A, again, 10%, Class B, 8%. The Class A split after the preferred return, nothing, right? You get the benefit of being first in line, but you get nothing else after that. Class B, they get their 70-30 split afterwards. And then we also have a hurdle there, so a performance hurdle. If we're able to exceed our projections ahead of time, faster on schedule, and we get you guys your money on a faster basis, then we have a hurdle where instead of a 70-30 split, it goes to 50-50, because it's incentive for us to make sure that if we perform well, then we get a little bit more incentive. So until you get your money where it's supposed to be and what it's projected out to, that 50-50 doesn't exist. We have to hit the certain 15% limited partner internal rate of return, which means that instead of your money doubling after a long period of time, if we get it in a shorter period of time, we can make that happen. Property management fees can be 3%. The asset management fee is going to be the 2%. And then the acquisition fee is also 2%. Capital transaction fee, like a refi or sale, is at 1%. And the fund uses $33.525 million for purchasing. Closing costs going to be $1.6 million. Repairs and reserves, 2.5. Total uses $37.725 million, right? So the investor equity that we're raising on this deal, total between Class A and Class B, is $16.4 million. So the property management, not only are we the operators, but we have our own in-house property management company. Again, if you guys have never dealt with third-party property management companies before, it can be a nightmare. As a matter of fact, it was so nightmarish, it caused Ben and Ferris to create Disrupt Management, which they're actually currently rebranding into another name. But Disrupt Management is our own in-house. We keep it like a family. I see these guys on the weekly meetings all the time, updating us about all the different assets that we have, the different projects that are going on. And so we're able to manage everything under a close eye. We don't have to worry about waiting for an update from the property management company or having to surprise them by showing up and just making sure that they're doing things right. They are our family. Like, we do this, right? And we've got 50 years combined experience in multifamily property management. Current oversight of over 6,000 units. District management team has a strong track record of operating assets all across Texas markets. So yeah, you can see where we are located in Houston, tons of assets. San Antonio, we've already got the 3, and then Austin, we've got 4 assets out there right now. And that's, we like the, the whole Texas triangle. There's actually some in Dallas as well that we've got. Another cool part of what we do is that we give a portion of the asset management fee to our charity, Disrupt Gives. It's a 501c3 compliant nonprofit charity. And the whole entire goal of this, right? So whenever you invest into the deal, part of that money is going towards this. And you can actually, if you're interested in getting a write-off for that portion as well, you can talk to us and our investor relations team and manage that as well. But it provides rental assistance and financial education to the residents, which is one of the things when I first talked about joining Disrupt. I told them, I was like, hey, I love doing this business. And one of the things that I want to do is I want to be able to teach financial literacy and help people out, because as an employee of HUD, I understood that the people that were struggling the most did not understand how money worked, didn't understand financial literacy and all these other types of things. As a matter of fact, just last night, I don't know if you follow my social media, but I was at Florida International University as a guest lecturer teaching people about underwriting and multifamily investing and real estate investing and all these other types of things. So I was able to help. It was the second time I was invited back to FIU to be able to teach people about these types of things. So that's what Disrupt Gives does as well, is not only teach people how financial literacy works, if they come across hard times and they qualify for it because they've had a good history and whatnot, and they just fall into some hard times, we actually do have rental assistance to be able to help them out for that. So it's pretty cool. And this is all of our assets, by the way, not just the ones that are Disrupt managed, right? We have assets in other states as well. So this is the track record for the deals that we've done. Average 50% return, 50%, 100%. You can see like a lot of these have been like way above what we were projecting on a typical 15% IRR, 20% ARR, somewhere in that range. And we've just completely decimated our goals historically. So 10,000 plus units managed across Disrupt Equity and Open Door Capital's portfolios. And our range is anywhere between 50 to 100% average annualized returns to our investors. So the investment process, the way that it's going to work, review this offering. If you guys need access to all this, again, I have this link here. I'm going to send to you. If you're watching the replay, you'll see it in the email as well. You click on that, fill out the information, and then I can schedule a call to be able to get you all that information, or get you to the investor portal where you can review the offering documents. There's going to be a private placement memorandum, very in-depth. It's going to go over the entire process, how it goes. You can e-sign the contract once you have read it and understood it and made sure that you're an accredited investor and all that other stuff. And the way that you do that, you can actually go and verify your accredited standing by going to a company called verifyinvestor.com, and they have a really easy process. You get your verification. I think it costs like $60 or something like that. And once you get that, then you can upload that into the portal as well as your proof of accreditation. Then you're free to sign and make your commitment to the deal. The funding process, you're going to use the investor portal. We go through Invest Next, and you'll be able to send funds by ACH or the wire, and they must be funded by September 1st, 2023. That is erroneous. That's not factual, because right now it's September 13th. I think getting this under contract took longer than we anticipated. So probably need to update that, but we're definitely still open to be able to get the funding in place. And then closing, Woodway, yeah, this part is funny. Scheduled to close in September. We were nowhere near that. Working with the lender and the seller and also the stuff to get everything done. Yeah, Freddie Mac, it took its time on this one. So we were just able to open up the investment process in September. So we're looking at potentially closing by December to be able to get this one done. And some of the investment criteria, 506C offering is open to accredited investors only. We do accept cash, self-directed IRAs, solo 401ks, EQRP, certain 1031s. At this point of the game, it might be a little bit late, but if you do have a 1031 that you're interested in coming in as a tenant in common to invest into this deal, let me know. I can, I'd have to talk to the investor relations team and see how we can get that sorted out. Minimum investment again is $100,000, and investors are accepted on a first funded basis. So even if you fill out all the documents, you upload your proof of accreditation, and you sign everything electronically, if you do not wire by the time the last dollar is into that account, then you are cut off from the deal. That's just the most fair way that we can estimate to be able to do this. Historically, Brandon and his team, they raise the capital on these deals. Once they start rocking and rolling, they pick up momentum very, very quickly. So definitely act fast sooner than later, because once the deal is closed, like the 57 million that we raised for the Texas 3-pack, that's closing next week. It went way faster than any of us anticipated. So while there is opening and opportunity right now, as of today's date, 9/13, don't sit on your laurels. Have the conversation with me. If you have any kind of questions whatsoever, let me know so that I can help address those, and then make sure that this is a good fit for what your investment strategy is. So if you're in, make sure you commit. Log into the investor portal. Again, I have that form there that's going to give you all of the information to make sure that you're going to be tracked properly, and then I can get you into the investor portal. You can e-sign the documents, make sure you have your accredited investor verification, and then you fund the deal. That's basically the very straightforward process. If you've never done it before, I can walk you through how it goes. Well, if you've done it before, it's like riding a bike. It's like, oh yeah, boom, fill out these documents, wire the money, talk to your bank, and then it's done. So some of the frequently asked questions that we've gotten before: can I invest using SD IRA funds? Yes, as long as your self-directed individual retirement account provider allows for it, and that the proper rules are followed. So you basically just talk to your SD IRA custodian and let them know, hey, I want to invest into this private placement. Am I allowed to invest into a private placement? They say yes, then you just get them the documents, and then you get them the wiring instructions, and then they will invest on your behalf. Distributions are scheduled to start after 6 months, but in that time frame, your returns, your preferred returns, are still accruing. So it's not like we're delaying the accrual of the money that we use. We're basically just building up an IOU account until the 6 months start, and then we're going to start paying that off, right? And then as we increase the rents, increase the quality of the property, and increase the valuation of the property, then that starts getting paid down. So your 8% preferred return is always going to be in place. And the same thing with the 10% as well for your Class A. How much are we increasing our expenses in year one? Year one expenses included about 14% average increase over the T12, and that's inclusive of a 37% increase in our insurance expense, as well as a 19% increase in our taxes. So we're very familiar, being based in Houston, about how taxes work. And on top of having our own management company in-house, we also have our own commercial insurance group in-house. We do it through SIG, Strategic Insurance Group. And so we have a really good schedule of insurance that's highly competitive, probably the best in Texas, which is why we do so much volume through there. And so our 37% increase in insurance expenses is not a guess. It's what we're currently writing right now. We already know what it's going to be. And if you guys have ever looked at multifamily deals and opportunities before, insurance and taxes are the two biggest expenses that are going to increase on takeover, because the value of the property had just gone up from when the previous seller had bought it. And so, you have to insure a higher amount, and you're paying taxes on a higher amount. Projected annual rent increases, very modest, 3% annual rent increase upon stabilization of the property. So in the beginning, we're going to have higher than that because we're doing the remodels and our rents are going to be growing. But once we're stabilized with the renovations being done, 3%. That's all that we project. And I think with the way inflation has been going lately and historically, 3% is highly, highly conservative. And when are we looking to sell or refinance the property? The current loan matures and roughly in about 7 years. and the management team fully intends to hold the property for 5 to 10 years, at which point we're either going to sell or refinance depending on market conditions. It's always dependent on market conditions. Let's just say hypothetically, there is no crash, no recession, things just keep going on as normal, and then the property just shoots up in value. Then we will sell sooner and get out of the deal. It doesn't make sense to be able to hold on to it. If we hit our target metrics, boom, we sell. We never want to be greedy and then, because maybe the recession comes after that. So whenever market conditions dictate the ability for us to be able to sell and hit investor projections, then that's what we're going to be able to do. And so that is basically it. I can open up the floor to any questions. If anybody has anything that they want to know, I like to be pretty thorough on this. So I wouldn't be surprised if you didn't have any questions. But yeah, let me know. What kind of questions do you guys have? All right. I mean, I do think it's pretty straightforward. Let me check on Facebook to see. Where am I streaming? Let me look over here.
It's Victor.
Hey, what's going on, Victor?
So for the distributions for those, I know this is always a question sometimes for some folks, and I don't most people, we live in the world where everybody wants their money and wants it right away, right?
Right.
And I understand the why behind the 6 months, but for those that don't, maybe you can kind of go in a little bit more in terms of why it's going to take 6 months before people start getting a return back on their capital.
Yeah, for sure. A little bit more in-depth explanation about that is you got to remember a lot of the money, all of the money that we're raising from the investors, Class A and Class B, are going into this deal. If we start paying distributions on day one before we have any added value to the property, we're basically taking money out of our capital expenditure budget because we've already paid the down payment, we've already paid the lender the closing costs, right? We paid all the fees associated with doing the deal. And now the only money that's left is our reserves and our CapEx budget. And so if we're not capitalizing on getting the upside from the property itself, we're basically taking Victor's money and then start paying Victor back day one without putting money into the renovations. And so we're going to put yourself in a really difficult situation by depleting your funds prematurely. So being able to do the renovations, reconcile the accounts, build up your reserves so that the property is in a bulletproof shape. I mean, I'm not sure if you guys have watched, but there's a lot of properties out there that are getting foreclosed on because they are running out of operational capital. Being able to delay the distribution of the capital, not the calculation of how much we're returning, because again, you're still accruing your returns. Even though you're not receiving a distribution in the first 6 months, we still have an IOU for how much we're supposed to pay you for those 6 months. And so that is when we start paying in the once we start paying the distributions in 6 months, then you're going to be able to we're going to start paying down that IOU portion of it, and then we'll get caught back up. And then once we have like a refinance event, or if we have a sale event or anything like that, all of the deficiency that we still owe you gets paid first. And then once you're caught up, right, to make sure that every single 8% preferred return that you had on that we owe to you is paid for in full, then we'll do our 70-30 split of whatever is remaining. Does that make sense?
Yes, sir. Yeah, thank you.
Very welcome. Very welcome. Excellent question, by the way.
To segue to that, one more follow-up question for those. Obviously the money's going to be sitting in an account, and then I'm assuming an interest-bearing account. Once we hit that 6 month or month 6, and the payments start, again, the distribution start, they begin. In terms of that interest, the investors or partners, whatever you want to call them, basically, do they get that accrual, that interest as well, starting on 6 month as well, or how does it work?
No,
Or do they not?
No. So the only accrual of interest earned is going to be on the preferred return, because that's what we're projecting and calculating. That's what our private placement memorandum documents are going to dictate, is that 8%. So if we're earning additional cash, right? So I guess mathematically, the only way that would come to the investors is going to be let's just say it's money in the account that we have to distribute on sale. That portion of the interest earned, even though however minimal it is, 70% would go to the investors, and then 30% would go to general partners. So it's not like that interest is accruing and we're just going to pocket that. Because again, the dictate of the returns on the deal are very strictly straightforward outline, right? Because we have to be SEC compliant. We collect the rents, we pay our expenditures, we pay our property management company, we pay our asset management fees for people who are running the deal. Then we pay the 10% preferred return. Oh, sorry, excuse me. Then we pay the note, right? We got to pay our mortgage first out of the net operating income.
Exactly. You have to pay all your expenses first.
Exactly.
And
So,
whatever's left, yeah, then you pay the.
Exactly. So even if we're accruing interest on there, all the expenses are lined up, and it's a straight shot, right? We know we got to pay our property expenses, taxes, insurance, all those other good things. And then we have to pay our mortgage, because the lender is the biggest part of the deal. So we have to pay the mortgage off. Once the mortgage is paid off, then we have our preferred return. So our class A is going to get 10% on their money first. Once they get paid their 10%, then 8% goes to the class B shareholders, which is going to be everybody who joins today and forward, because there's no more class A share spots. There's a wait list for it if you want to sign up for that. Most likely it's going to be class B at the 100,000. And then once you have the class B 8% paid out, then we have 70% going to the limited partners, and then 30% going to the general partners. That's how it's going to go. And so if the money is accruing interest, sure, fine. Our capital accounts are growing. That money is going to be paid out accordingly. And so whether it's, kind of hard to pinpoint exactly where the pennies go, but mathematically, it's just the money comes in, we utilize it to operate the property, and then we pay our distributions according to our private placement memorandum with the waterfall structure that I've outlined on the deal.
That makes sense. Thank you.
Hey, you're very welcome, my man. Another question here in the chat. Great presentation, great deal. Is there a general partner opportunity remaining on this deal? Let's have a conversation offline about that, because I want to be able to adjust the limited partners specifically on this call. And anybody, I couldn't check the comments in Facebook. Nope, nothing over there. And yeah, so that was it. So I appreciate you guys taking some time coming out and spending this time with me here. I'm gonna drop that link as well, meeting group chat right here. So that's the form that you fill out. Express your interest in investing into the deal. If you're watching the replay, it's going to be in the email as well. Once you get all that stuff filled out, I'll go ahead and we can schedule a call and get you the investor portal link so that we can make sure it's a good fit for you guys. Any questions that you have, I'd love to have a conversation about it with you. Let me know. I will be traveling this weekend because I'm going to be speaking at an event going from Friday to Sunday. But beforehand, I should be able to be gotten a hold of between today's Wednesday. Yeah, today's Wednesday and tomorrow, Thursday. I'll have some time. And then if not, next week will be good. And hopefully Open Door Capital doesn't go crazy and just fill up this whole entire thing. I think the fastest raise I've seen them do was $20 million in 24 hours. It was nuts. So, all right. Thank you guys so much for coming in, and I will go ahead.
Hey, Russell.
Oh, hey, what's going on? Hey, what's up, Caleb?
Hey, when you say it's going to be, the replay will be sent to our email, is it just like an automatic send to whoever showed up for this?
It's going to go to my entire investor database. So I don't think I'm required a registration for this. So if you guys are not in my investor portal, you need to, I gotta find that link. Well, if you fill out the form that's on here, I'll send you all that information because I'll have your email there. So yeah, anybody who signed up for this and put their information on the form, then you'll be getting a replay. If you didn't fill out the form, then I don't know how to get in contact with you. Then that makes it very difficult. So yeah,
that sounds good.
Good question, man. You look good in your welding gear.
Hey, I'm out here trying to get out of the welding life, but it'll come.
Yes, sir. All in due time, my man.
Yes, sir. Hey, have a good day.
Hey, very welcome. You too. You're welcome, Lynn. Welcome, Bryant. And Marzi, we'll talk to you soon. Jonas, we'll talk offline, my man. All right, everybody. Have a wonderful Wednesday. I'll talk to you next time. Peace.